Silver is on the edge of something historic. In my previous video, we saw the unprecedented early rollover from December to March, the strongest rollover Comex has seen in years. But before we even reach March, shorts begin losing the battle long before the delivery window opens. Let's break it down step by step. This is MarketVelugu, light on markets. Rollover itself is normal, but what we are seeing right now is not normal. At the beginning of November, December OI was above 100,000 contracts. March OI around 34,000 contracts. As of November 26th, December has dropped to around 9,000 contracts and March has surged past 112,000 contracts and is still rising. This is the earliest, fastest, and largest rollover into a future delivery month in recent Comex history. Why does this matter? Because large traders, the ones who actually take delivery, are avoiding December completely. They're clustering into March, and the market has never concentrated risk like this before. March 2026 is becoming the most important silver month in decades. Even Bloomberg recently confirmed that China's silver stockpiles have fallen to the lowest level in a decade, and emergency flows into London have already taken place, meaning physical metal is becoming increasingly difficult to source. When a top-tier global demand center shows decade-low stockpiles while restricting exports, the margin of error evaporates. That's why the March rollover accelerated. Traders are front-running physical tightness. Now let's talk price. Silver has been clearly respecting this August trend line and has formed a bull flag, which is now breaking out. So the target for the bull flag is around $75 per ounce. Let's zoom out and look at the long-term chart for silver on a monthly basis. So this is the long-term Fibonacci regression channel for silver, and the 61.8% golden ratio is also pointing towards a $75 per ounce for silver. Now looking at the cup handle formation that has formed for the last 45 years, silver first hit a high of $48 in January 1980 and then bottomed at around $3.46 in February 91. The cup formation completed in April when silver hit a high close to $50 and the handle bottomed at around $11 in March 2020. The cup handle formation completed in October 2025 when silver hit a high of $54. November is on track to close above $50, the highest monthly close ever for silver, which is also the breakout of the cup handle on a monthly level and also a psychological resistance at $50. Now let's look at the cup handle target since the breakout has been confirmed. The top to bottom for this cup, if projected upwards, points to $670 per ounce. So this is the cup handle target for silver plotted on a log scale. A $600+ per ounce. Here's the strongest early warning signal. Shanghai futures in China are now trading above Comex. Notice the divergence since November 12th. Shanghai prices have broken away from the rest of the pack and are accelerating upward. This is a big deal. Comex futures are primarily financial contracts. You can cash settle, you can roll month to month, you can treat them as paper. But Shanghai futures, silver requires actual delivery into warehouses. It's tied to real physical supply inside China, not global speculation. So, when SHFE leads higher, it tells you one thing. Physical demand is forcing the price upward, and when physical leads, paper eventually follows. A rising SHFE premium is one of the clearest signals that the global spot price is about to reset. And here's the part most people never think about. Before March, before deliveries, the shorts start bleeding cash every single day. Why? Because futures are marked to market nightly. If silver rises $1, every short loses $5,000 per contract. If it rises $10, that's $50,000 per contract. With over 100,000 contracts for March, a simple $10 move creates a $5 billion mark-to-market hit on shorts, and a $20 rise creates a $10 billion notional loss. To survive, they must immediately add more margin, inject new capital, absorb losses, and survive every nightly settlement cycle. Even before delivery begins, margin pressure becomes a slow motion squeeze. This is why shorts fear even small increases. It drains them long before March arrives. Now let's imagine silver hits $75 as we enter the March window. Here are the key dates. First notice day, February 27, 2026. The delivery month officially begins. Shorts must show they have metal. Last trading day is March 26, 2026. This is the big one. Anyone still short risks being assigned physical delivery. Let's explore their options. None of them good. Option 1. Roll into May. Rolling is not free. With backwardation, rolling costs money. With rising prices, margin requirements explode. And May is also a major delivery month, meaning the pressure only shifts, it doesn't disappear. Buy futures to cover. Option 2. If they try to buy back shorts at $70 or $80, the covering itself sends silver even higher. Short covering becomes a self-reinforcing loop. Option 3. Provide physical metal. This is the nightmare scenario. Comex realistic deliverable float is around 10 to 20 million ounces. If even a small percentage of longs stand for delivery, say 25 million ounces, Comex struggles. Shorts simply cannot source the metal. Option 4. Do nothing and pray for a pullback. This is the most dangerous strategy. Every dollar higher bleeds more margin. Every day of backwardation tightens stress. Every premium in China or India pushes the market further away from them. So what happens if silver hits $75 before March? Here's the map. Margin pressure destroys weak shorts. Shanghai premiums lift global spot. Comex rolls become expensive. Delivery risk rises. Shorts face impossible choices. This is how a structural squeeze forms, not in a single day, but through months of tightening until eventually the system snaps. When every other option fails, futures exchanges have one final lever: cash settlement. No bars, no trucks, no warehouses, just money. This has happened before. The 1968 gold pool, the silver crisis of 1980, 2020 SLV restrictions, and 2022 nickel cancellation. When the physical market overwhelms the paper market, the exchange chooses survival, not metal. If March 2026 forces cash settlement, Comex loses credibility, and Shanghai and India, the real consumers, begin setting global silver prices. This is how a new global silver price is born. Whether silver reaches $100, $400, or $600, what matters is that 2026 may finally be the year the real silver price emerges. A year where 5 decades of pressure finally releases, and the anchor of suppressed pricing breaks. And for the first time in modern history, price discovery shifts from the paper markets of the West to the physical markets of the East, where the real metal, the real demand, and the real power now reside. This is MarketVelugu, Light on Markets. If this analysis brought you clarity, don't forget to like, share, and subscribe so you never miss the truth behind the markets.